I have about 1 million questions, and we've now gone through the pros. I want to go through some of the cons and some of the big issues with this company. Let's just call a spade a spade. Right now, this is a money-losing company. It does not make money today, correct? It's still losing money?
On a per-unit basis, on an operating margin basis, it is almost at break-even in profitability. By 2023, we will have overall profitability.
Okay, so we still have to wait 4 years, though, or 3 years, rather, for profitability. Big issue in terms of being able to compete with the big guys. I'm talking about Humana, United Health. The metric that investors look at in terms of success is MLR, medical loss ratio. What is the medical loss ratio for Clover versus the big guys?
Great question. Great question. Out of the box, they're already meaningfully better. And what's great is their gross margins start better because they're a technology business, and we think it's going to get better and better over time. And the reason why is because they create transparency. They don't play games. They don't motivate doctors to upcode or do all kinds of things in order to get paid. They've created an extremely transparent and efficient business. So their gross margins out of the box are better, and we think they're going to continue to only get better relative to the companies like United and Humana.
Okay, and then we have to talk about the issue we always talk about, which is fees. And I know we went back and forth on this a couple weeks ago with your last SPAC, and Jay Clayton, the head of the SEC, has spoken out and said that he wants to bring much more transparency to fees, given that you want to democratize the IPO process and allow more retail investors and others to get in. Let's just walk through it. I want you to walk through it in a very granular way. How much money you as the sponsor are getting, what percentage of the company you're getting as a result of this?
So in the case of IPOC, I think we invested $16 million to get it off the ground. Now that the deal has come together, we've invested another $160-odd million in a pipe. The total investment by myself and my partners is about $171 million. The post-money valuation of this business is sort of $5-odd billion, and so we'll own about 5 or 6% of the business.
You'll own 5 or 6% of the business. That's it.
Yeah. Now, from my perspective, I think that that's a wonderful. Go ahead.
Go ahead.
No, I just think what I'm
just
trying to get across is
there's no warrants. There's no warrants or other preferreds that would get you to a higher percentage of the company.
Again, this is all on a fully loaded basis. So I want to make sure that you're not confusing fees with investment. Fees, I don't make any, right? And just to remember how a SPAC works, a SPAC is not dissimilar to many other investment products. So for example, if you take a private equity fund or a venture fund or a hedge fund, we all operate very similarly. There is a principal. We raise money from investors. We allocate that capital. Typically, funds take a 2% fee every year. We do not. And all organizations typically take 20% of profits if it works. Incrementally, what we do is we reinvest more money from our own so that we are aligned with the company, the employees, and all shareholders. So just to give you an example, Andrew, across all 3 SPACs so far, IPO A, IPO B, and IPO C, we've invested more than $450 million of our own money. Typically, we are 15% of every single dollar invested. And the reason we think it's important to be this meaningfully at risk is that I think it creates better diligence. It does create better disclosures. In fact, when you look at the S-4s that we filed when we merge with businesses, they have enormous amounts of detail. And it creates the right alignment. There is no way that I can win unless the stock goes up.
Right.
For example, in Virgin, for the first 2 months, when the stock went down to $7.25, I looked like an idiot. Now when the stock is 18, obviously, or 20, everybody can say, wow, great deal. Same thing with Open Door. There is risk in all of these things, but the reality is that I'm putting my own money, and what I'm trying to do is put my reputation forward and say.
And you're getting no But what you just suggested was that you're getting no promote.
No, that's not what I'm suggesting. What I'm suggesting is that you have $16 million initially, plus $160 million on the back. Total. I've just told you what we own.
So you're saying now that's going up to about $250 million right now, automatically?
Yeah, for example, in Open Door, the position that we have invested, so we put, I think, $12 million initially up front, another $155 million. I think that was $169 million we invested total. That's a 2.x on our invested capital. So what I'm trying to tell you, Andrew, is like, this is not some get-rich-quick scheme, at least for me. There are different SPACs where you can take a very different form of compensation. You can put a very little amount of money. You don't have to invest on the back end, and you can have much higher multiples of return. I've chosen to take a different path. And hopefully over time, what people see is there are high-quality businesses, a high-quality sponsor, and we're trying to do a thoughtful job so that when employees and shareholders win, we can win as well, and we think that that's reasonable.
Shepard Smith here. Thanks for watching CNBC on YouTube.